Good morning, traders. Today is the 26th of April, 2021. My name is Neville Hornsey, market analyst with U Trading, and I'm joined today by
Joel Frank, also market analyst at U Trading. How you doing, Nev?
Very good. Yeah, just in my new digs. So you've got a new background.
Very nice.
And I see that you're in a new place as well.
Yeah. Well, I'm going to hopefully be doing a bit of work with my uncle going forward.
The big trader. Cool. The 30-year trader.
Well, yeah, I mean, he's the big man. He's been working in markets for like 33 years now. Yeah. So I'm excited. A lot to learn from him.
How did he?
But yeah, this is the living room. So
yeah. So
new background.
Yeah, the last time we did speak and your uncle was mentioned, it was the NFP on the bank holiday Friday. Did he have any thoughts about that afterwards, like with you, or did it sort of just pass without too much drama?
God, that was a while ago now, wasn't it? Yeah. That was at the beginning of the month. I mean, I can't remember exactly what he said, to be honest. But I mean, it was a beast, wasn't it?
Yeah.
What was it? It was like 900K jobs. Yeah. I mean, to be honest, like the US economy is just on fire right now, isn't it? Like what did we have last week? We had retail sales and PMIs.
Beat expectations. Yeah.
Yeah. Exactly. This week we've got GDP, which is probably going to be, I mean, I don't know. What do you reckon it's going to come in at? Like, I think it could be close to 10%.
I think they're going for China figures. Like when China was like uber, like expansionary, I think they're going to try and compete with those type of numbers. And when I think back to like when China was like top of the game for, I don't know, like double digit sort of GDP, it was because they were just pumping so much money into infrastructure and that type of thing. But then also, if you think about all of the stimulus, government spending, as it has been, is part of the GDP sort of equation. And we're in the trillions. So it's got to be, if the economy was like a $5 trillion market economy, like last year, or 6 trillion last year, then it must be like 7 or 8 now. So they must have put a good 20% into the markets, and they're only going to extract a little bit out. So by the sounds of it, so
GDP, I mean,
it's going to be big.
It's going to be big, definitely, because you had the stimulus in January and then again in March.
Yeah, I think we're on like stimulus. So like if you were to break down each one, I think we're on like number 5 or 6 now. I think I seem to remember reading like in terms of all the little bits added together.
Except they've been getting bigger each time.
Yeah, exactly.
Like the last one was just colossal, 1.9 trillion. Like, gee.
And in terms of like extracting money out of the economy, if the Biden sort of administration tax plans were to go ahead, I doubt it's going to be as big as they say. They kind of just like put the bar really high for negotiation, I'd imagine. So we'll see.
Yeah, I think you make a really important point there, because like, I mean, we're about to talk about stocks first anyway, but like US equity markets are still pretty close to all-time highs. S&P500 is still pretty close to, it's just under 4,200 at the moment, isn't it?
Yeah, it's 4,174.
Yeah, and I think if the market believed that these big tax hikes were coming, then it wouldn't be that high, or it wouldn't be that frothy. But like you just said, like they put the bar really, really high, but they don't actually have that much room for error in Congress, do they? Like they've got moderate Democrats who they've got to get to agree, and they've only got a very slim margin in the Senate. They've only got 51 against 49. So,
and like, did I read it correctly that if the tax plans were to go through on capital gains, that it would be sort of backdated to 2013, like in terms of like if you made capital gains between investments on 2013 investments to date, that would be the sort of period that they would tax heavier. So if you'd like,
I haven't heard about that, but you might be right. But that would seem a bit harsh, though. You know what I mean?
Because if you like made like a 2008 prediction of S&P at 4,250 or something, you know, when it like bottomed at the great financial crash, then you would have like super amounts of gains. And then if you got in at say 2013 on a dip, it seems a bit harsh.
It seems well harsh, because imagine if you made all the money back then, you paid your taxes, honestly, and then you just spent the rest. Like, what are you going to do? You're screwed.
Yeah, no, exactly. No, I think, well, we'll see. I mean, I don't think, like you say, they're going to be able to get it all through. So,
but here's another key point, another important point. I can't remember where I saw this. I think it was a couple of news wires were picking up on it. Or actually, it might even have been the Biden administration that said it. But even if they do get the tax hikes that they want, like the doubling of the capital appreciation or the capital gains tax, apparently only 0.3% of Americans will be affected anyway. So it's not really like it's not really going to change anything for most people. So I don't think it would be as big a drag on the broader economy as maybe the headline kind of suggests.
Yeah, and it'd be interesting, like, because going back to just before the US election, Biden was like saying, well, calling out Amazon and Netflix especially, and saying that he wanted those type of companies to pay more tax percentage than the average, American. So, and the S&P, it had a bit of a dip on that news, but
it was one day.
but it's flat as of yet. It's like at the highs of 2 weeks ago. So
yeah. And I think as long as this week's US GDP data is good, which I very much expect it to be, and the Fed also on Wednesday, as long as they are as dovish as I think everybody expects them to be, I don't really see why US stocks should suffer.
Jerome's Mr. Powell's indicated like so many times now that he's not going to be raising interest rates for a good couple of years. So, and they're going to carry on doing their quantitative easing. So I think it's as is plus stimulus, which has gone into the stocks. Earnings are beat, and GDP is big. So
earnings, earnings. That's going to be important this week too. Yeah, you seen anything in the chart, Nev?
All right, so you can see just a big trend line.
Mate, bullish.
12 months of up. And it's hard to know. Like, I mean, I'm not going to start doing Fibonacci sort of extensions because there's obviously the sky is the limit. But a pullback to, find support, that would be this sort of balance area back in March, so that middle of March 2021. That's what 1, 2, 3, 4. So if we have a fifth straight week up, and all of the earnings and GDP and FOMC's priced in, I mean, you don't really get more than 5 green candles before a pullback. So this might be the last hurrah until we pull back. Until we pull back. I
wouldn't call it the last. But maybe we see
for this month. Like next month is like another 5 weeks of gains. But they might pull back. I don't know, early May.
It's a nice area to support that, isn't it?
Yeah,
that 4K.
So four of the big figure. Then there's like a couple of highs that were printed. Swing highs on the older sort of technical analysis. But in terms of where the main lot of trading, like sideways trading, was the balance area, it was sort of March, and April's been just immense, hasn't it? So we could have a 200-point pullback, assuming that we don't go 200 points higher this week. But if whatever happens this week, I think I'll be looking for people to take profits, because you very rarely get 5 large big momentum candles. Like here we had like a grind. So I'm discounting that red, and I'm discounting that red. That was just little weeks just grinding higher. Really, we're not doing that now. We're like pushing on.
It almost feels like a bit of a melt up at this point. I mean, April has been more consolidation, I guess, so it's not really been a melt up as much this month. But I think it'd be healthy for the market to have a pullback. I think so. I mean, mate, I'd be all over that dip, like literally.
I think we have to. Until we actually get, I mean, this is like the significant swing low, like into this sort of area here from the beginning of the year. If we were to break the sort of 3,700 level and then sweep the lows, I'd be interested to see what happens then, like in terms of, but I don't know what would cause a reversal in the markets. Like,
I feel like potentially for a pullback that deep, we might have to have some negative developments. Like perhaps that could be, I think potentially could be to do with central bank, to do with the Fed. Like maybe they get worried about inflation and they start thinking about tapering their asset purchase program a bit sooner. Maybe they start bringing forward rate hikes. Yeah. That could potentially be something that does it. Or some really bad coronavirus things happen, like maybe a new mutant variant that vaccines don't work again.
I guess if the sort of news that's in India, Brazil, those sort of countries, like really highly dense population, if that was to start happening again in America, rather than because the curve is being flattened in America now. So if it was to like spike higher. The only other thing that I was thinking of was maybe something like Russia, Crimea, Ukraine, America, because like President Biden seems to be all over Ukraine in terms of, he's big on supporting them and sort of slandering, if you like, Putin. So
he's quite hawkish in terms of geopolitics, isn't he?
So that's a potential, but
I think only if it really, really kicked off, though.
And
which I don't think it would, to be honest.
It's not warmongering at the moment, is it? It's just sort of just discussing their views and displeasure at people sort of encroaching on other people's lands. But that would be. But I don't think there's anything really like we haven't got North Korea kicking off. We haven't got anything really in the pipeline that I know of, like, to worry about.
I mean, I think the big risk is potentially something to do with the central bank. And then also, like you were just saying about just a healthy pullback, markets getting a bit frothy, people start taking profits and I think that's the risks, if there are any. Yeah,
if there are any. What other markets do you think would benefit from this froth?
I think let's talk WTI, because you just started talking about some stuff which like you're talking about India and like it's terrible what's happening in India at the minute.
It is really
that's not really affecting US equities, but it is affecting crude. Like I think we're probably down more than 1% this morning.
It was definitely coming down. Get the
don't know if you want to get the chart up, but like India it's been record infection rates for like the past 5 straight days, and the daily death toll is like shooting up, and the scenes in New Delhi and stuff are just awful. Like people, it's not really nice to talk about, but people literally dying in their cars because the hospitals are overrun. And obviously India is the 3rd biggest oil consumer in the world, and they're going into lockdown. Basically in lockdown, all their economic activity is like shooting lower. So not good for the near-term outlook for crude oil.
No.
And there's other countries that are going into lockdown as well. Like Japan is doing a state of emergency in a couple of its major areas. Not good news for the near-term outlook.
No. And this even like OPEC plus. I mean, I was reading stories about OPEC plus having some sort of legal sort of, the US Senate was going to like pass a bill to NOPEC they call it, don't they? So what I don't understand, like they're going to try and sue OPEC for lying about their what are they suing for? Like are they
I guess it's because when it comes down to it, OPEC is a cartel. That is like an anti-free market sort of thing, isn't it? So
but it's the way it's always been. It's like, why sue them
I know.
But anyway,
it's not going to happen. I doubt it'll happen.
But in terms of the sort of supply restraints from the majors, I thought that was going to add to the price, but it hasn't. The last few days, it just hasn't really done anything. It's just going back into this consolidation period. But I guess if they can't get on top of the coronavirus, then I would not be short in oil right now. It's going to come into major support. You've got the 50 day EMA, then you've got the 200 all the way down here. So if it was to drop, then maybe we'd come down to $50 per barrel. But there's going to be a lot of chop before we get that.
I mean, it'll be an interesting week, won't it? Because it's like all of that positive economic stuff with the US that we were just talking about, but then all of this negative, with the pandemic getting really bad in other countries. And then OPEC, like you say, how much are OPEC going to be concerned by like what's happening in India? that's going to be an interesting question.
Well, they won't be able to like increase their production, will they? If they can't oversupply the market again. I mean, they can do what they want, obviously, because last year.
But if they don't want to kill prices, then that's what they should do. Yeah,
I think they're enjoying these higher prices, and I think they're over there to race to the bottom, sort of thing. I guess another commodity would be gold. That's not really doing a lot now. I thought that was going to be bullish, as I thought crude was going to be bullish, but it's not really. It's not giving those vibes anymore, is it? It's kind of found its resistance.
It's been doing all right in the last couple of weeks, rising back from those lows under 1,700. Kind of helped by, because the dollar, I'm actually quite surprised at how badly the dollar has performed in the last couple of weeks.
Yeah.
And I'm also surprised at the fact that US government bond yields have pulled back as much as they have. And the fact that dollar is lower and yields have pulled back from highs, that's definitely been helping gold.
Yeah. With the yield thing, that does feel like it is more speculators trying to front run or squeeze. You can't squeeze the Fed, but you can kind of push, the sort of steepening of the yield curves and stuff. But that seems to be like coming off now, doesn't it? The bonds are being bought and the yields are being sold off a little bit.
Yeah. And then the dollar doesn't like that as well, because the dollar trades a lot off of like these rate differentials. I mean, I'm really kind of conflicted on the dollar, because on the one hand, like I started off the year quite bearish, but then the US economy performed better than I expected with the vaccine rollout and with all the stimulus, and the data has just been amazing. And then the dollar strengthens. And I was like, okay, so the US economy is outperforming and the dollar is strengthening. So I was just kind of thinking, as long as the US economy continues to outperform, which at the moment it looks like it will, then the dollar should continue to strengthen. But now we've had these weeks where the dollar's been getting slammed the last like 2 weeks. So now I'm like, what is the dollar going to do? Is this because the US economy is outperforming and the Fed is still really dovish? Is that a dollar negative? I don't know. It's a tough one, I find.
Yeah, no, I think technically it's bounced between that consolidation from like last autumn and this consolidation from 2018. So it's
maybe this is our range for a bit.
Yeah, and I mean, if we say the momentum, if it was just indicated by the EMAs, is pointing down, it looks like the 50-day is going to roll over along with the price. So it's, technically coming down for now. If we were to get below those lows from 2018, there's a little else to aim for until you get down to like the 85 sort of level, which is probably a bit more scary.
Personally, I don't think we'll get below those lows.
Yeah. So
maybe we'll test them, but I just, because the US economy is just doing too well. You know what I mean? I just don't see a reason why we would go like, down to like 85 or something.
And I guess like we're not looking at like a trade weighted dollar. We're looking more at the sort of dollar index, which is heavily based on the euro as well, isn't it? So if there's inflation in the euro, then if you look at the euro sort of curves, that they point upwards. So maybe the euro is going to appreciate and the dollar index is going to find that being heavier on it. But
maybe true.
We'll see. Looking at another cross, British pound, US dollar. I'm just waiting to see if we can get some just out of this like 200 or 300 pip range. I've got it like the 1.37 here and the 1.4. We've just been like in that for weeks now.
Yeah. That 140 has been quite a tough.
Yeah.
I mean, are we still below it? Yeah,
we're still below it. Yeah. So the only way we're going to get above it is if the dollar index, like the whole dollar sort of complex does drop.
Yeah.
So
I think you're right.
But I guess dollar down, gold should go up. If it was to go up, then we could call this some sort of bull flag. And if that was
potentially.
If that was a bull flag, then I guess you're supposed to take that and then
as the pole. Yeah.
Yeah, as the pole. Yeah. And then pop it up there. I mean, that seems, yeah, I don't know about that, but.
I don't know about that.
2,000 would be nice.
I mean, you never know. If inflation goes really insane and the Fed is just like head in the sand, no, there's no inflation, then you never know. Maybe it could.
Well, in the same way they said, this is not QE, this is not inflation. Is that what you're saying?
Yeah, exactly. Exactly. We're not printing money.
Yeah, we're not printing money. And there is definitely no inflation, even if gold's at 2,500. I don't think we go that high, but it would be good to see some sort of measured move, somehow. So
yeah, definitely.
Cool. I think that's kind of covered the basis.
Yeah, we covered the major ones. Yeah.
Anything else that we should be thinking about, like today, like in particular? It's like
there's not much today.
Yeah.
Not really that much today. Maybe keep an eye on some, US political situation. There's always commentary on, the spending plans and stuff. But in terms of the major events this week, we already kind of touched on it, like the Fed, US GDP, but we've also got GDP from a lot of other countries as well. Like we've got GDP in the Eurozone, and then other major central banks. Bank of Japan, that's going to be boring though. And yeah, I mean for me those, and then earnings as well. Obviously, keep an eye on earnings. That's my major events this week. I don't know. You watching anything else?
No, I'm just going to try and capture, if this is going to be some sort of blow off top week, which I'm, what we kind of talked about, just try and get buy equities. That's what I'm going to try and do. But to be honest,
jump on the dips.
Yeah, this is my least profitable week when there's FOMC type stuff. The market,
okay, fair.
The market seems to like go dead in terms of like the way I like to trade before, and then it kind of waits for the next month's NFP, and then it's the Monday after NFP that I can start to trade again. It seems like the market always seems to do me in this FOMC week. So I've
dirty this week.
So I've learned to trade really small, like when the central banks and this type of stuff. So
fair enough, mate.
Might dabble, but not a lot.
Yeah. Words of wisdom.
All right. Well, have a great week, and I'll catch up with you
mate. You too.
next Monday.